The streets of South Mumbai are quiet in the hours before dawn, but long before the opening bell rings across Dalal Street, the fortunes of millions are already being calculated. Many retail traders fall into a familiar routine, looking at domestic earnings and local moving averages while treating the Indian equity market as an independent island. The reality is far more complex. The opening setup is inherited from an invisible web of anxieties and compromises forged overnight across trading days from Wall Street to the Middle East. Today's specific environment is dictated by three external pillars: a shift in global risk appetite, a downward recalibration in crude oil prices, and a wave of sector rotation quietly moving capital. Ignoring these overarching macro signals ensures a trader walks into the morning session blind to the trends actually driving the Nifty. The most pressing weight on the market this morning comes from the Middle East. Whispers of a potential peace deal between the United States and Iran have rippled through the commodity sector, deflating the geopolitical premium, keeping oil elevated. Because the Indian economy imports the vast majority of its crude requirements, a drop in oil acts as an immediate macroeconomic relief valve. If we map out this relationship, cheaper oil creates a direct sequence of reactions. A lower oil price suppresses the risk of imported inflation, which then eases the pressure on the national current account deficit. This cooling of inflation expectations provides targeted relief to the banking sector. With price pressure subsiding, domestic bond yields find a solid anchor. The central bank can observe these external shocks without aggressive monetary tightening, ensuring system liquidity remains calm. Yet, beneath this surface calm lies extreme fragility. Geopolitics relies on human negotiation, which is inherently unpredictable and prone to instant fractures. A single broken negotiation or negative headline can cause volatility to expand, erasing those macroeconomic gains in a matter of seconds. Looking westward, United States equity markets are scaling all-time highs fueled by intense momentum. This bullish euphoria easily crosses borders. It encourages risk-taking behavior across emerging markets, pushing Indian equities higher on the global tide. However, this optimism carries a sobering counter-warning from the European Central Bank. The ECB has cautioned that global valuations are currently priced for perfection, leaving major markets dangerously stretched. A straight-line rally masks underlying systemic risks. Momentum is strong right now, but the shadow of a sharp correction remains ever present. Navigating this landscape demands forensic discipline. Traders must meticulously chart support and resistance levels, mapping out the precise breakout zones where institutional capital will clash. Within India's domestic borders, these global capital shifts are triggering localized sector rotations. The first rotation is the resurgence of Adani Group stocks, recapturing market focus and injecting a concentrated dose of volatility directly into the broader indices. Simultaneously, the renewable energy space is reacting to a shift in domestic policy. Solar equities brace for a margin boost driven by new domestic content rules favoring local manufacturing. Capital is rapidly reallocating to catch this policy tailwind. The third rotation highlights a paradox currently defining the Indian consumer durable sector. Looking at the data, the consumption story shows a clear divergence. Sales in premium high-end products are rising while demand in broader mass market segments is cooling. This divergence within the consumer durable sector shows why buying the entire category as a single block is a risk. Success here requires identifying the specific equities positioned to benefit from the high-end consumption trend. When the morning silence shatters, the first hour of trading becomes a crucible of emotion and capital. Global optimism and the relief of cheaper oil often collide to gap up the market at the open. Retail traders face an intense temptation to give in to this early euphoria and blindly chase the morning surge. But the market is a ruthless mechanism built to punish overconfidence. Giving in to opening euphoria frequently traps eager buyers at the day's peak. The seasoned professional handles this first hour very differently. They watch the open, refuse the impulse to act, and deploy tactical patience. They wait exclusively for structural confirmation. They know the market provides an endless stream of information, and the first major news of the day usually dictates the true direction of capital flow. To survive the chaotic beauty of the trading day, you must remain fiercely protective of your emotional discipline and anchor your capital strictly to the global data, not the emotion of the opening bell.